to another episode of Money Moves with Debt Rescue. This week we're going to be talking about debt, but types of debt, not just the general discussion, but digging a bit deeper into it. The kind of debts we can incur, what's good debt and what's bad debt. Let's face it, debt is everywhere around us. We incur debt on anything from buying the house and bonding that property to vehicles, store cards, personal loans, even using it sometimes to have to buy our groceries or appliances. The important thing to know is, when is debt a necessity? When is it a good thing? When is it something I should be applying it for? And when I should rather be saving and trying to rather buy the item cash? During the past 2 years since the pandemic has started, it's also placed an enormous strain on the average South African consumer as to how to keep up with their living expenses, and more often than not having no option but to move into debt to try and pay for the necessary items that they need. And also, with the stresses and the difficulties that we face during this period, it's also become one of those situations where we want to reward ourselves for the difficulties we've been through. And sometimes when we do that, we end up incurring debt to make ourselves feel better for some of the tough times that we've had to face. Adding to all the other pressures, of course, us average South Africans also want to climb that ladder of success to show that we have achieved something during our careers. And over and above all the other obstacles we've faced during this period, we're trying to keep our lives together and measure the successes and the good things that we've achieved. And oftentimes the success means different things to different people, but more often than not, it includes some material and materialistic items that we prove to ourselves how we've become successful. And part of this, unfortunately, sometimes would include us getting into debt. And that's why it's so important that we understand and distinguish the differences between good debt and bad debt. So your most obvious and most common form of good debt is generally, for example, purchasing a property, because over the period that you repay your bond, the value of that property would increase. Another important, sometimes underestimated form of good debt is investing in an education. When you invest in your education, for example, getting a study loan or a loan to go and advance your studies further, this is a good opportunity where obviously in the long term, you'd possibly enhance your opportunities for employment or improve the employment that you currently have. So that's one that's always good to look at as well. We don't want to throw away all other forms of debt and just say they are bad, but a good measuring stick is to say, if the item at least maintains a large portion of its value by the time you've repaid it, then it's possibly going to be categorized into the good debt category. Bad debt, on the other hand, are items where they depreciate really fast or have no value by the time you've repaid them. Now, this would include, for example, technology, unfortunately, and items like getting a loan to buy clothing, etc. Unless you're investing in something really long-term, the value by the time that you've paid it off is not worth what you'd end up paying when you look at factors like interest. Remembering that all debt will incur some form of interest, factoring in, if you were to pay it off over a couple of months or years, what the total cost of credit was for that item and whether the item is really worth it in the end. One of the biggest concerns right now is obviously incurring debt if you have to buy groceries. If your intention is not to pay that debt back, for example, if you've got a store card or a credit card that you're using to purchase those groceries on at the end of the month before interest is charged, that you rather than relook your budget, because purchasing something that's consumed within a very short period of time on credit is a very, very dangerous decision to look at. Another dangerous item, specifically when it comes to the bad debt, is when we look at purchasing food on credit. The moment you have to purchase food on credit, your intention should be to pay it back as soon as possible before interest charges are raised, for example, on a store card. If you are having to purchase food on credit, it's a very important time to start looking back to your budget if you are not able to pay it back, because something that is consumed before it is paid is obviously a very dangerous part of debt. Though there are obviously certain circumstances where you cannot avoid debt, such as medical emergencies, it's important to know that try and provision for it ahead of time, for example in savings, but if you can't, that you then have a very strict action plan in terms of how to deal with repaying that debt as fast as possible. So when we incur debt, one of the biggest factors we need to look at is our interest rate. And we often get asked, how does the credit provider determine what interest rate I get charged? And this takes us to our credit reports. It's very important to understand that credit active consumers have a credit report. And a credit report is a combination of all the various debts that you've incurred over a period of time and what your risk factors are to the credit providers if they were to grant you credit. Now, your credit report contains quite a lot of very important information on your credit repayment history that you've had before. And it's important to remember that your credit report does not contain just your credit agreements, but also certain service agreements, such as insurances and your cell phones as well. So it's important to know that your payment history determines to a large degree the interest rates that you'll be charged. While there are certain circumstances within which you have no choice but to incur these kinds of debts, such as medical emergencies or having to, for example, repair your vehicle, it's important to note that try and make provision before the time by putting aside some money in a savings account so that you don't have to, but that if you do, have a plan in place on how you can repay that debt as fast as possible. So your credit report contains a credit score, and that credit score is an algorithm based on a bunch of various factors that the credit bureaus would put together. And like I said, important ones are you paying at least the minimum installments every month, as well as paying on time, obviously. A credit score is generally based anything between 0 and 1,000 points, depending on the credit bureau and their exact ways of doing it. Obviously, the lower that your credit score is, the higher risk you are considered, and the higher your credit score is, the lower risk you are. So factors that they are looking at would be what is the probability of you paying on time, and paying at least the minimum amount that you would be required to pay every single month. So as you can see from that credit score table, that is an example of how the credit score is laid out, and obviously that will determine the amount of money, amongst other factors of course, as well as the interest rate that you would get charged if they do grant you the credit. So debt is an inevitability for most of us in South Africa. At some point in our lives, we are most likely going to have to incur credit or debt for something that we might need to purchase. But it's important to understand before we do, what is the total cost of credit and what are the factors that could determine, for example, the interest rates that I might be charging. Very important to differentiate between wants and needs before we enter into them. That's it for this week's episode of Money Moves with Debt Rescue. Please subscribe to our channel, like this video, and please comment in the box below if there's anything you'd like us to discuss as a topic in the future.